allocation of a stock or bond portfolio. There are numerous adages that might assist you in deciding how to distribute stocks and bonds in your portfolio. According to one theory, your stock portfolio should have a ratio of equities equal to 100 minus your age. So, if you're 30, your portfolio should consist of 70% stocks and 30% bonds, or other safe investments. If you're 60, your portfolio should consist of 40% equities and 60% bonds. The basic concept here is sound. As you got closer to retirement, you can preserve your savings by putting more of your money into bonds and less to stocks. However, critics of this idea may say that, given our longer lifespans now and the proliferation of low-cost index funds, which provide a cheap, easy type of diversification with often lower risk than individual equities, this is an overly cautious approach. In today's society, some suggest that subtracting 110 or even 120 from your age is a preferable method. For most investors, the decision to invest in stocks or bonds is based on their risk tolerance. How much short-term volatility are you willing to accept in exchange for higher long-term gains? Vanguard conducted a study that looked at data from 1926 through 2019 to examine how other allocations might have done during that time span, as seen below. Keep in mind that when it comes to annual averages, no single year closely resembles the average. For example, the S&P 500 lost 37% in 2008, but returned 26.46% by the end of 2009, largely erasing 2008's losses. The Bloomberg Barclays U.S. Aggregate Bond Index, on the other hand, rose 5.24% in 2008 and 5.93% in 2009. Dividends and preferred stock. Large, reliable corporations that consistently make substantial profits are frequently the issuers of dividend stocks. Rather than investing these gains in expansion, they frequently transfer them to shareholders in the form of a dividend. The stock price of these companies may not climb as high or as rapidly as smaller companies because they aren't aiming for rapid expansion, but the constant dividend payment might be important to investors trying to diversify their fixed income assets. Preferred stock is a fixed income investment that is riskier than bonds but less risky than common stock. It mimics bonds even more closely. Preferred stocks pay out dividends that are often higher than both the dividends from common stock and the interest payments from bonds. Selling bonds. Bonds can also be sold for a profit on the market if their value rises over what you paid for them. This could occur as a result of changes in interest rates, a better credit rating from the credit bureaus, or a combination of these factors. Investing in riskier bonds for high returns, on the other hand, often negates the purpose of bonds in the first place, to diversify away from equities, conserve capital, and provide a cushion for rapid market losses. Thanks for watching. See you again in the next video.